Hello friends, welcome to my channel. This is CA Rakhi Agarwal. Today's topic is related to Ind AS 10, which deals with event occur after the balance sheet date. Which means that any event occur after the balance sheet date, but before the approval of financial statement by the board of directors. That period is to be considered as event occur after the balance sheet date. So let's start our topic. Definition of event occur after balance sheet date. Event occurring after the reporting period are defined as event which occur between the end of the reporting date and the date when the financial statements are approved by the board of directors in case of company and by corresponding authority in case of any other entity. The events are favorable or unfavorable events which occurred after reporting date but before the approval of financial statement. So what does it means? That any event occur after the reporting period. Reporting period means 31st March and before the approval of financial statement by the board of director in meeting. That event which occurred between these two dates, between the reporting date and the approval date, the event which occurred between these two dates is to be considered as an event occur after the balance sheet date but before the approval of financial statement. So any event occur between these two dates is to be considered in this Ind AS 10. So it's to be accounted as per Ind AS 10. So the events are favorable or unfavorable events. Both are events occur between these two dates. So how we will this to be explained by example. Suppose the reporting date is 31st March 2021 and the board will approve the financial statement on 31st May 2021. So and any event occur between these two dates. Suppose like the inventory obsolescence. The inventory has obsolete due to fire. Fire broke out in company and inventory has lost, or there is a loss of inventory which occur on 30th April. So that event occur after reporting date but before the approval of financial statement, that is on 31st May. So that is to be an adjusting event. It should be considered as an adjusting event and it should be adjusted before finalization of accounts. Even the event occur after the balance sheet date, but it occur before the approval of the financial statement. So it is an adjusting event. So the company will adjust that kind of events in their financial statement and make a proper disclosure of that. What do you mean by approval of financial statement? In case of company, date of approval by board of directors shall be considered as a date of approval of financial statement. Mean in case of a company, when the board of director approve the financial statement, that date is to be considered as a date of financial statement. If in case suppose there is a more than one meeting held by the board of director, suppose there is 2-3 meeting or 4 meeting they will consider for finalization of accounts. So the last meeting or the final meeting which they held, in which they finally approved the financial statement, that date is to be considered as a date of approval, final date of approval of the financial statement. So date of approval by the board of director shall be considered as date of approval of financial statement, If the financial statement are approved in more than one board meeting, then the final meeting in which the financial statement are finally approved by the board shall be considered. So date on which the financial statement is finally approved by the board. If more than 2-3 meetings they will take for approval, the board of directors will take for approval, then the meeting in which they finally approved the financial statement, that they considered as a approval of the financial statement. So suppose I am taking the example, the reporting date will be 31st March 2021, and the first meeting will be held on 31st May, and the second meeting will be held on 31st August, and the third meeting will be held on, or which is the final meeting, which will be held on 30th September. So 30th September will be considered as a date for approval of the financial statement. So, and the event which occur between these two dates is to be considered as an event occurring after the balance sheet date, but before the approval of the financial statement by the board of directors. So, if the approval from any supervisory board is required to be taken, the date of approval by such supervisory board shall be considered for identification of events after the balance sheet or reporting date. It means that any approval, it means that if a approval from supervisory board is required, then the date of approval by the supervisory board shall be considered as a approval date for the financial statement. Means, suppose in article of association or memorandum it will written that please take a date, please approve your financial statement. After taking approval by the board of directors, please take the approval from the supervisory board. Then the supervisory board approval is required for approval of the approval of the financial statement, and that approval is date is to be considered as the date of approval of the financial statement in case of Ind AS 10. So this is to be explained by example. Suppose the reporting date is 31st March 2021 and the board has approved the financial statement on 30th May, and suppose the supervisory board has approved the financial statement on 30th September. So 30th September is to be considered as an approval date of board. So in case of partnership firm, in case of company, we has discussed that date of approval by the board shall be considered as an approval date. In case if 2-3 meetings board of director will take for finalization of accounts, then the date in which the financial statement is finally approved by the board, that date is to be considered. And in case of supervisory board, if the supervisory board approval is required, then the date on which the supervisory board approved the financial statement, that date is to be considered under Ind AS state. In case of partnership firm, approval by partner on the financial statement shall be considered as date of approval. Means, when the partner will approve the financial statement, that date is to be considered as date of approval. In any other entity's case, approval by the respective authority, the respective authority of the entity, when they approve the financial statement, that date is to be considered as a date of approval. Now, type of event, there are two type of events which occur after the balance sheet date, that is adjusting event and non-adjusting event. Adjusting event are what? That event that companies know at the reporting period that this event will occur after the reporting period. The event which indicates on the reporting date that the event will occur after the reporting date, then that is to be considered as an adjusting event. And a non-adjusting event are those events which are not indicating that they will arise after the reporting date. They are uncertain events. So the event which are uncertain and that will not exist on the reporting date, that event are considered as a non-adjusting event. So adjusting events are those that provide evidences of condition that exist at the end of the reporting period. It means, so in this case, adjustment needs to be made in the financial statement. If you know that the event will occur after the reporting period, you will make an adjustment in the financial statement. So that kind of event are known as an adjusting event. That is, for example, settlement of court after balance sheet date. That company know that this case will settle after the reporting date. They will make adjustment. They will make provision of that in the financial statement. Provision of inventory obsolescence. If they know, yeah, we have to make the provision of inventory because it is loss. The company know that the inventory, the condition of inventory is not good, so they will make a provision of that. Provision of impairments of property plant and equipment and tangibles. Provision for doubtful debt. Company knows that the data is not good, they will make a provision in the financial statement. Provision for bonus issued to the employee. Company know that we have to give the bonus to the employees. So that event occur after the balance sheet date, but the provision is to be made on the balance sheet date because we know that the company know that they have to pay bonus to the employee. So they, after the reporting date, though they need to make a provision of that. Company is going into liquidate. Some liquidation case is going on and company know that after the reporting date the company is going to liquidate. So they will make adjustment accordingly. If any fraud discovered subsequent to the balance sheet date, then that adjustment is also called, that event is also called as an adjusting event. In that case, the board will approve. Once the board has approved the financial statement, and if the fraud occur after that, then the board will, they make another meeting and they will revise the financial statement accordingly. Non-adjusting events are what event? That does not indicate on the balance sheet date, on the date of reporting, but it will arise after the date of reporting. Suppose fire broke out due to any loss due to earthquake. So that event is not existed. The company does not know that after reporting that it happens. Uncertain events happen after the reporting date. That is to be known as non-adjusting event. Those that are indicative of a condition that arose after reporting period or does not exist on the reporting period. So in this case, adjustment are not considered in current financial statement. So in these cases, adjustments are not considered in the current financial statement. Disclosure needs to be made for the impact on financial statement. It means that because non-adjusting event, in case of non-adjusting event, adjustments are not required to be made in the current financial statement, but in next financial statement adjustment is required. But in the current financial year, adjustment is not required to be made because the event occur, there is no indication that it will non-adjusting event. There is no indication on the reporting date that the event will occur after the balance sheet date. So adjustment is not required to be made in the financial statement, in the current financial statement, but the disclosure of the impact of that transaction is required to be made in the financial statement. Disclosure is required, but the adjustment is not required. So some of the examples of non-adjusting events are acquisition of a subsidiary. If the company has decided to acquire any subsidiary after reporting date, so the adjustment is not required to be made. Disposal of PPE subsequent to the year end. Discontinued operations subsequent to the year end. Change in foreign exchange rate. These are the events which occur after the balance sheet date, but before approval, still they are non-adjusting event. They are not adjusted. These events are not adjusted in the current financial year. Now, this is to be explained by example that suppose ABC Limited, the date of reporting of ABC Limited is 31st March 2021 and date of board approved the financial statement is 15 June 2021. Subsequent to the approval, fraud notice by the company and the board decided to make a revised financial statement. So they again make a meeting on 30th June 2021 for their final approval. So they had made an adjustment due to fraud occur after the approval period, but they had revised their decision. So that effect is to be considered as an adjusting event which occur after the balance sheet date and before the final approval of the financial statement by the board of directors. So this revised date is to be considered as a final approval by the board of directors. So next example we are taking, suppose ABC Limited date of reporting period is 31st March and date of court order that the company is liable to pay tax. Suppose some court case is going on the company and the case is not in favor of the company. The order passed in not favorable to the company and the company has to pay taxes on that. So the court ordered that the company is liable to pay tax on 15/4. The order is passed by the court that company is liable to pay tax on 15th April 2021 and the reporting date is 31st March. And the final approval by the board of director of the financial statement is 15th May 2021. So it's an clear-cut and adjusting event because it occurs between the court order occurs between the reporting period and the approval of the board of directors. So it's an adjusting event. Company has make adjustment of that in the financial statement, in the current financial statement, that is 2021. So it's an adjusting event. Now we will discuss another topic, that is breach of loan covenant in case of long-term loan. This we will discuss in Ind AS 1 also. Loan covenant means loans. What are the loan terms and condition? If a company breach any loan terms and condition, then what happened? What was the implication? If there is a breach of loan covenant in case of long-term loan due to which such loan is repayable on demand, but the lender has agreed subsequent to the balance sheet date, means the date of approval of the financial statement by board, but not to demand such loan, then it will be considered as an adjusting event. Means if there is a breach of loan covenant in case of long-term loan is there and the company has breached the terms and conditions of that loan. So due to which the banker demand the loan on that please pay our loan, repayable on demand. But what happened? There is some discussion between the banker and the company and the lender has agreed, waived off the demand. Okay, you will take You will take your time. We will not demand. We will demand our amount after the approval by the board. So, but the lender has agreed subsequent to the board means the date of approval of the financial statement not to demand such loan. The banker agree not to demand loan. So then it will be considered as an adjusting event. The event which occur after the reporting date before the approval by the board of directors, and the bankers or lender decided not to demand loan from the company, then it should be considered as an adjusting event. It is also considered showing in the balance sheet as long-term loan. Recognize such loan as long-term loan, and loan agreement has been waived. Loan is to be payable as per what they had decided, that original repayment schedule. Accordingly, the company has to pay the loan. Now there is another topic, going concern. Going concern is what? That the company will run or not. It will be decided on the reporting date that the company is able to run in future or not. Financial statement with the company is prepared on 31st March is on going concern basis or not. An entity should not prepare its financial statement on going concern basis if the management determined after reporting date either that it intends to liquidate the entity or to cease trading, or that it has no realistic alternative but to do so. Means an entity should not prepare its financial statement on going concern basis. If the company has decided, if the board of directors decide that after reporting date they will find that the company is not going to run anymore, that the company is intent to liquidate or cease to do operations, then, and there is no other alternatives to run the business, then they does not prepare its balance sheet on going concern basis. In case the company is going to liquidate subsequent to the reporting date, which means only subsequent to the reporting date, then the financial statement should be prepared on an RV, and the company is going to liquidate, then subsequent to the reporting date, then the company has to prepare its balance sheet on fair value, that is NRV, and not on going concern basis. NRV, that is means NRV fair value means any amount expect to realize from asset, whatever the company has to, in case of liquidation, the company has to sell all its assets, and whatever it expect to realize from that asset, that is the NRV, and what amount expected to be paid to to settle its liability, that is NRV. Means whatever the company get at the time of liquidation by selling its asset, that is the expected amount to realize, and that is the NRV for the company in case of liquidation. And what the company is required to pay to settle its liability, what expected amount the company is required to pay to settle its liability, that is the fair value in case of liquidation. So it means if there is an event which indicates significant doubt on the company to continue its business on going concern basis, such event needs to be disclosed. So if there is a doubt that the company will run in future or not, then the company will disclose in the financial statement that it is not a going concern basis or it is a going concern basis. Like we will take the example of COVID scenario. Every financial statement they had make a point that the company will run or not. What was the company's status? Management is aware of material and uncertainty related to event or condition that may cast significant doubt upon the entity's ability to continue as a going concern. The event or condition requiring disclosures may arise after reporting period. So, management is aware of the material uncertainties related to events or conditions that may cast significant doubt upon the entity's ability to continue as a going concern. The event or conditions requiring disclosures may arise after reporting period. So, disclosures required to be given that the company is going to run on a going concern basis, or if there is a doubt, then the adjustment is not required, and if the company is going to liquidate after the reporting period, then the company is required to make its financial statement on fair value, and it should be disclosed in the financial statement. Then another topic is dividend accounting. Dividend accounting in the books of holding who invest in its another company, means in its subsidiary company. Take an example. Suppose H Limited is holding 100% shares of its subsidiary S Limited, and S Limited declares dividend. So how the company H Limited will make a treatment of that dividend in its book? Dividend in the books of H Limited has to be recognized as at the time when right to receive dividend has been established. When the company established the right to receive the dividend, they will recognize then only in their books, in the books of H Limited. Right to receive dividend, when it will be established? It gets established when such dividend is approved by the shareholders in the AG. And how the treatment in the books of S Limited, that is subsidiary? Dividend shall be recognized in the year in which such dividend is declared. When the means S Limited has declaring the dividend, and in the year in which they are declared, they will recognize, and not in the year to which it pertains. It means that suppose the dividend is for the period for the financial year 2021, but it is declared on after the reporting period, that is on 31st May or 31st July. So that period is not considered as dividend to which it pertains. So, the year in which the dividend is actually declared, in that year it should be recognized. So dividend shall be recognized in the year in which such dividend is declared, and not in the year in which it to which it pertains. For example, date of reporting is 31st March 2021, and date of dividend declared by the for the financial year 2021 is rupees 10 lakhs. Means the company has declared dividend for the financial year 2021 is 10 lakhs. And on which date? 31st July 2021. The amount of dividend, that is 10 lakhs, recognized in the books of S Limited in the year in which the company declares dividend, that is on 21-22, and not in the year 2021 to which it's relate. Now this is the appendix, that is distribution of non-cash asset to the owners. Now what is non-cash assets? Non-cash assets are property, plant, equipment, inventories, business which the company distributes to its shareholders or to its owners. Who are the owners? Owners are Who are the owners to which the company distributes this dividend? The owners are the investee of the company. The person who invests, the company who invests in that company, they are the owners, but not the holding company. Other than holding company, the person who invests in that company and the company distribute dividend on that as a non-cash event, that will be covered under Appendix A of Ind AS 10. Means under IFRS, the above topic covered as IFRS 17 embedded as a part of appendix in Ind AS 10. It means under IFRS it is this topic, distribution of non-cash asset to the owner, is covered under IFRS 17, which we had taken, which the Indian company Ind AS has taken from IFRS IFRS 17 and embedded in Ind AS 10 as a part of Appendix A. So this appendix says that any distribution of non-cash assets as dividend to an investing company, then it is covered under this standard other than holding company. Means this distribution is not applicable to the holding company. This distribution is applicable only to the other than holding company. Means this is explained by example. Suppose H Limited holding the share of S Limited, 80% of the share of S Limited. So holding subsidiary relationship exists and the balance 20% is taken by another company, that is A Limited. So the value of property, plant, equipment carrying amount is 2 lakhs and the fair value of that asset is 3,50,000. So the amount of asset at fair value, this amount of asset at fair value is to be transferred by S Limited to A Limited as dividend. They will transfer this amount. They will declare the distribution of non-cash assets to the owner. Means in this appendix, the owner will be the A Limited and not the holding company. To the owner, that is the other than holding company, though the person other than holding company who invest in that company is to be to whom the dividend of non-cash asset is to be given under appendix A of Ind AS 10. So these amount of asset at fair value is to be considered by S Limited to A Limited as dividend. So any non-cash amount given by S Limited to A Limited is considered under appendix A of Ind AS 10 and not to the holding company. These holding companies is not covered under this. So how we will make an accounting entry? Suppose at the time of declaration, retained earning account debit, that is at fair value 3,50,000 to dividend payable, and then the dividend needs to be reviewed, and every year the dividend which is given by the company is to be reviewed on each balance sheet date, and if there is any change in the value, that should be adjusted with retained earning. On distribution of asset, at the time of distribution of asset, what the company will how the company will pass an entry? They will debit the dividend payable with at a fair value, that is 3,50,000, and they will credit the PP at carrying value, that is 2 lakhs, and the balance amount 1,50,000 is to be transferred to profit and loss as other income. So the difference in carrying value and fair value is to be recognized to PL. And so if now this is the example. So if after the end of the reporting period but before the financial statement are approved for issue, an entity declare a dividend, and for after reporting period but before approval, if the entity declare a dividend to distribute a non-cash asset to it shall disclose the company shall disclose the nature of the asset, what kind of asset they are distributing, the carrying amount of asset to be distributed at the end of the reporting period, and the fair value of the asset to be distributed at the end of the reporting period. And if it is a difference, that it should be recognized as a under the PL, profit and loss account. So this is the disclosure requirement, and this is the distribution of non-cash asset to the owner. So please share and subscribe and like my channel. Thanking you for watching my video.